Hi, and welcome back again to Tim Bigham's Options and Volatility Newsletter. We'll be taking a look today at a vol capture or captures update on Archer Aviation, ACHR, where a little over a month ago, some big time option buying and big time vol popping set up ideally for vol capture trades and the result of those. So let's jump in and take a look. First of all, here's the original trade video coming out on November 29th. We'll see in a second just how big that vol pop is that set up the trade. Those who want to watch, certainly here's the link up here to go back and take a look at the trades we kind of took a look at, and we'll update at least the April ones here. So the basis behind the trade was that huge jump in implied volatility. Here is the 60-day implied volatility, again, November 29th. Ended up peaking, right, at almost 165. You can see it was pretty well behaved before that, hanging around that 80 level on the 60-day. The 120 IV popped in a very similar manner here, as you can see, peaking out on November 29th. 360 IV again, this huge run up, right, of IV again peaking out at those levels on November 29th when it got to an extreme. Taking a look at the skew, we identified that, which is the difference between the call IV and the put IV. The unusual option activity was all centered for the most part in the calls, where they were willing to way overpay for the calls versus the puts. You can see call IV reached an extreme over 20 IV point difference, which ended up being the highest level over the previous 52 weeks on November 29th. You can see that since then it has softened, and as of the last reading, basically back to flat at negative 0.1, so basically returning to normal. So that big skew in call buying also reached an extreme, another reason to jump in and take advantage of overpaying for these options. So the trades were all predicated on looking for that IV to revert back, as we always do on that. So a couple of the trades we looked at on November 29th, one was a simple sell strangle out in April. We also did a July and a January, which we will update later. Those are working out just nicely as well. But here on November 29th, right, you can see with the stock at 957, that sell strangle, selling the $9 put and the $11 call, would have gotten you somewhere around $5.70 based on that huge jump in implied volatility on the trade. You can see previously on November 24th, before all that huge call buying, it was trading at a much lower IV, but we're able to sell that high IV on November 29th. Again, that IV that reached these extremes up here for those November options. Taking a look at the 120-day, again, selling close to 150 IV on that trade. Actually, 144.0 is where you could have gotten it, selling that strangle for $5.70. You would have been able to pick up about a penny a day or so on each option that you sold, and you would have been 33 deltas net short. That huge spike in IV actually pushed deltas a little bit higher, right, because the calls are actually further out of the money than the puts, with the stock at 957. The calls are about $1.50 out of the money. The puts only about 50 cents out of the money, but because of the lower price of the stock, it's under 10 bucks, and the increase in implied volatility, right, the call delta is actually at a higher level than the put delta, so you would have been net short about 33 deltas. Fast forward to the latest close, we can see that the stock went up to 1048, so the stock did rise in price, but that strangle price now dropped to 350. You could have sold it for about 570 back on November 29th, closed at about 350, the latest close, because the IV now has fallen from over 140 to 105 on both the calls and the puts. Theta is still at 2. The delta is still hanging at negative 30. The stock has risen, right? The deltas have actually come down from a IV perspective, but because the stock went up, right, the deltas have now switched to a more normal, the calls trading at a higher delta than the puts, because now the calls are only about 50 cents out of the money. The puts are $1.50 out of the money. So we've had, since the original trade on November 29th idea till now, 41 days have passed. So you expect to make about 80 cents or so on theta. In other words, time premium decay on this trade, right? Every day that passes, we're selling a call, selling a put, you pick up a little on time decay, right? The deltas, though, we were, remember, short 33 deltas to start, now short 30. So our smooth delta, a little bit over 31, right? The stock did go up a little bit less than a buck, so you can expect to lose, from a delta perspective, somewhere around 30 cents, right? So you'd expect to make a little bit more than 50 cents on the trade, given the fact you can pick up some time premium decay, but you give some of it back on the delta loss. Instead, you're actually able to pick up $2.20. Why? Because of this huge drop in IV, right? That drop in IV, as we can see from the peak here at just under that 150 to now the lowest level we have seen is certainly over the past several months by far. So that's set up ideally for that vol capture trade. So the vol capture component of the trade, right, that $2.20 gain, about $1.65 is due to the fact that you had this IV come back down, revert back towards normal, didn't revert all the way back. We'd be more than happy to take the trade off now. We usually look for about a 67% reversion, right, back towards where it was. We're certainly right at those levels now. It also factors into the shorter term trades, right, and as well as these longer term trades, right, that selling it up here and looking to cover it here. So our January position and our July positions both faring well as also. Our iron condor trade that we talked about, right, here it is going back to the day of that peak in implied volatility, right? The iron condor, which is selling the $12 call, buying the 14 in April, selling the $7 put, buying the $5 put as a hedge, right? So you have 2-point wide spread on either side. You could have gotten $1.50 because of that huge jump in IV that reached, as we said, that 140 level or so. The price was $1.50. Our risk on this trade doing it was only 50 cents. So you have a very nice 3-to-1, return to risk component on this trade. Max you could risk is 50 cents, right? If ACHR ripped above 14 or ripped below 5 and stayed there all the way until April expiration. Certainly, given a look at where the stock was, not a likely outcome, and that absolutely proved to be the case as we fast forward now to the latest close, right? We can see that iron condor basically cut in half. You could have sold it for $1.50 back here, right, when that IV was trading at these extremes. Now it has dropped back down towards a more normal level, right? That IV has tempered the price of that iron condor from $1.50 to under 80 cents. Why? Because IV is now just over 100. Before it was over 140. So another way, in a defined risk manner, right? Very low risk, right? Only risking 50 cents initially on the trade, right? You could have had a 70-cent gain for risking 50 cents, with basically the stock going nowhere in a month. And our buy right trade, right? We also talked about the buy right going back to the peak of IV back on November 29th. Stock closed at $9.57. That April 12 call at $2.62. So that buy right, which is simply buying the stock at $9.57, selling the April 12 call at $2.62, would have cost just a little bit less than $7. The implied volatilities we set on these calls, April 12 calls, over 146 at the time, right? That's back at the peak of this implied volatility after this huge run up here. Fast forward to the latest close, you can see the stock has gone up in price, right? However, the April 12 call, right, $1.75 has actually gone down in price, believe it or not. So you have the stock up, the calls down. So that buy right, which we were able to get into initially back here at just under $7, that buy right is now pushing towards $9. Why? Because the IV on the calls we sold dropped from over 140 to near 100. So even with the stock up 91 cents, our calls dropped almost 90 cents. So in essence, the buy right, we made about 90 cents on the calls, made about 90 cents on the stock, simply because the stock IV dropped enough to make the calls drop in price, even with the stock moving up about 10% over the past month or so. So that buy right, you would have been able to capture almost a $1.80 gain, right? Very nice percentage trade. And why? Because the IV on those April 12 calls dropped almost 43 points. We were able to sell those calls at over 140, buy them back at almost 100. So hopefully it provides insight into identifying these big, unusual pops in implied volatility based on the big option volume. And you can see here is all the big trades out there on November 29th. The volume kept coming in on the calls, identifying that, putting on trades that look to benefit from a reversion in implied volatility extremes, all while doing it in a defined risk or a delta neutral fashion. So until next time, as always, here's the good trading. Take care.